Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First AI boom threatens 3 to 5 million white-collar jobs amid surging GDP growth, creating a jobless growth paradox for the Fed. So we'll discuss why this paradox challenges the Fed's traditional playbook and what it means for the future of interest rate policy. Second Bank of America flags a 5% average S&P 500 drop on government shutdowns, but a potential data blackout complicates historical precedent. We'll examine how this political standoff and a potential data blackout may impact Federal Reserve policy and overall market stability. Third, a 110% surge in office deals clashes with a 90% construction collapse, creating a barbell market that threatens regional banks. Today, we'll take a closer look at this market split and its implications for institutional investors and the stability of regional banks. A stark warning is hitting Wall Street directly from the architects of the AI revolution. The message? Prepare for a loss of 3 to 5 million jobs in the next 3 to 4 years, and it could happen even faster. That explosive forecast comes from David Zervos of Jefferies, who says he's hearing it directly in meetings with the smartest AI guys, the very investors who have made fortunes on the technology. The interesting part is that these job losses aren't expected to be spread evenly. Research from institutes like McKinsey shows the impact will likely be concentrated in specific white-collar sectors, think administrative support, customer service, and other office functions. This is what economists call sectoral unemployment dispersion, and it can be a leading indicator of broader labour market stress. And what's really striking here is that in the past, automation fears were mostly about blue-collar manufacturing jobs. Now, the threat has moved into the office. A while back, we highlighted how layoffs were oddly scarce because companies were labour hoarding. The latest development is that AI-enabled efficiency could break that stalemate in targeted white-collar pockets first. However, if you zoom out, you'll see another layer of strategy at play that has the Federal Reserve in a bind. This massive job loss isn't predicted to happen during a recession. Instead, Zervos paints a picture of an economy that is otherwise booming, potentially growing at 3.5% or even 4%. He calls the AI growth story something really pretty spectacular. This actually builds on our last discussion about the data war, with durable goods, orders surging, housing perking up, and firms front-loading investment. That kind of strength can coexist with rising joblessness if productivity is doing the heavy lifting. So the thing is, we're witnessing a paradox that economists are calling jobless growth, a situation that deeply challenges traditional economic thinking. For example, we've recently seen official data showing the US economy expanding at a strong 3.5% annualized rate, beating expectations. But in the very same period, the unemployment rate unexpectedly rose to 5.2%. Strong economic output is happening at the same time. The labour market is weakening. This is exactly the disconnect we flagged when we said the next payrolls reports would be the tell. This creates a serious dilemma for the Fed and its dual mandate. How does the central bank react when the engine of spectacular economic growth is the very thing causing unemployment to tick up? Remember, the Fed itself recently warned of downside risks to employment, and Chair Powell called policy modestly restrictive. The new wrinkle is that the risk may stem from I-driven displacement rather than classic demand weakness. The Fed's playbook is built for a different world. Traditionally, strong GDP growth would signal an overheating economy, prompting rate hikes. But with unemployment rising, the Fed would normally be expected to cut rates to support the job market. This is the bind they are in, and we've already noted how the dot plot was all over the map. This kind of split screen data is exactly what widens those internal divisions. Now, here's where it gets interesting. There's a fascinating historical parallel. Some economists are wondering if we're seeing a Greenspan moment 2.0. Back in the 1990s, the internet boom led to a massive surge in productivity that acted as a disinflationary force, allowing Fed Chair Alan Greenspan to keep interest rates low even as the economy grew rapidly. It's a potential game changer for markets because if AI delivers a similar productivity boom, it could allow the Fed to tolerate this high growth without hiking rates. We're already seeing micro-level evidence of this. One study found that call center operators using AI tools became 14% more productive almost overnight. Zervos, who has been named as a potential candidate to replace Fed Chair Jerome Powell, argues the central bank is overlooking this threat. He contends that policymakers should be more focused on the labour market right now than on inflation. That aligns with our earlier point that the Fed has been pivoting toward preventing a sharp rise in unemployment. And this isn't just a US story. There are significant global implications. To put it in perspective, private investment in AI in the US reached $67.2 billion last year, nearly 9 times that of China. This massive investment advantage is accelerating a new kind of offshoring for white-collar service jobs. We're seeing evidence of this in trade data with the US services trade surplus, with countries like India and the Philippines starting to shrink. This suggests more service work is moving offshore, which could worsen the jobless growth problem in the US. The core conflict is that the AI boom, once seen as a purely positive force, now comes with a devastating catch. The same technological wave driving unprecedented growth is now forecast to create a significant employment crisis, challenging the very foundation of the Fed's mission. So, what should we be watching? The key focal point is the American consumer. If these predicted job losses materialize, people will cut back on spending. This is the biggest risk the stock market might be underestimating. We warned a while back that the fading pandemic savings buffer could set up a consumer spending cliff pair that, with targeted white-collar job losses and the risk compounds. From here, watch the next non-farm payrolls, prints for widening sectoral cracks, and consumer sentiment for further slippage. This will be the true test of whether the AI boom can coexist with a healthy economy. We were just talking about the complex economic dilemma posed by AI. Now, let's turn to a more immediate man-made shock to the system, a potential government shutdown. Now, get this. Bank of America just dropped a number that has Wall Street on edge. Looking at data since 1990, they found the S&P 500 averages, a staggering 5% loss in the period surrounding these political standoffs. A 5% drop is significant because the S&P 500 is a direct reflection of current market sentiment, signaling a serious, immediate loss of confidence. A while back, we walked through why these standoffs keep happening. Congress still hasn't passed the 12 appropriations bills, and with a 60-vote hurdle in the Senate, neither side can move alone. That's the backdrop to the choppiness BofA is flagging. But that's not the whole picture. The real turning point is that history shows a shutdown isn't a one-way ticket down. During the event that stretched from late 2018 into 2019, the market did the exact opposite. The S&P 500 actually rallied an incredible 6%. In fact, research from JP Morgan puts that 2018 to 2019 gain even higher at over 10%. The market's reaction is never consistent. It all depends on the bigger economic picture at the time. So what gives? According to Bank of America rate strategist Mark Cabana, markets typically care far less about government shutdowns than they do about the risk of a full-blown debt ceiling breach. After all, a shutdown is an operational problem. The government can't spend new money. A default, on the other hand, is a credit crisis. The government can't pay its existing bills. That would be a catastrophic event. And this is where the situation takes a more complex turn. The focus today shifts to the macro backdrop. Some on Wall Street are now sending up flares, warning that the current weak economy could make a shutdown far more impactful than in previous years. The market's ability to absorb political shocks may be wearing thin. There are 3 key reasons for this. First, a consumer spending sudden stop. If a shutdown lasts more than one pay cycle, hundreds of thousands of federal workers and contractors lose their income. Unlike in past shutdowns, household excess savings are now largely depleted. This means a sharp drop in spending could hit the economy much harder and faster. The Congressional Budget Office estimated the last major shutdown permanently erased $3 billion from the economy. Second, there's a new problem. A data blackout. A shutdown would halt the release of key economic data, like the all-important inflation and jobs reports. We previously analysed how this isn't hypothetical after the 2013 shutdown. Key reports were delayed by about 2 weeks. Without them, the Fed is essentially flying blind, forced into a cautious holding pattern. This policy paralysis injects massive uncertainty into the market, which investors absolutely hate. Finally, from a broader international perspective, this kind of political gridlock signals a declining US state capacity. For a Chinese audience, this is particularly noteworthy. Chinese state media, for instance, has previously characterized shutdowns as exposing chronic flaws in the American political system. These self-inflicted wounds can fuel talk of de-dollarization and undermine US credibility in global affairs. This decision brings both historical precedent for a drop and a surprising potential for a rally. This creates a high-stakes guessing game for investors, with a new warning that the weak economy changes the entire equation. So what's next? Keep an eye on high-frequency data, like weekly credit card spending, to see if consumption is truly falling off a cliff. Also, pay close attention to any statements from Federal Reserve officials on how they plan to navigate a potential data blackout. Their words will carry immense weight. The takeaway is clear. While past shutdowns have produced wildly different outcomes, the current economic climate has convinced some analysts that this time the market has far less of a cushion to absorb the shock. Speaking of investor sentiment being pulled in different directions, the commercial real estate market is presenting a fascinating duality of its own. The story begins with a decision that caught everyone by surprise. The office market, left for dead by many, is seeing a capital surge that's more than doubling the momentum of any other property type. According to exclusive data from JLL, their own office sales transactions skyrocketed 110% in the first half of 2025. Across the entire industry, that translates to a staggering $25.9 billion in deals, a 42% jump year over year. The number of bids on any given property is up 50%. This isn't just a rebound. It's a fundamental shift in investor mentality from office curious to office serious. Demand for blockbuster deals of $100 million or more has exploded by 130% as institutional capital and pension funds rush back in. This signals a major shift because a real estate recovery typically follows a specific sequence. First, private investors jump in, then the REITs. The final and largest wave is institutional capital pension funds, insurance companies, and endowments. Their arrival signals that the market is maturing and believes in the long-term value of premium office space. But what really brought this to a head was the next development on the supply side. New office construction isn't just slowing down, it's hitting a brick wall, according to one JLL executive. Deliveries next year are set to plummet 90% below recent historical averages. Believe it or not, a drop this severe is almost unprecedented, falling 90% below the average seen even after the 2008 financial crisis. This historic collapse is setting the stage for a major supply shock. As companies compete for the dwindling number of high-quality spaces, we could see a sharp, supply-driven spike in rental prices within the next 2 to 3 years. At the same time, companies are no longer dumping space. In 2022, relocating firms cut nearly 20% of their footprint. Today, that number has collapsed to just 3%, a clear sign of stabilization. When we place the surge in big money deals alongside a different game being played in the shadows, the contradiction becomes clear. So-called dark matter assets, distressed towers once worth $300 a foot, are now being snatched up by bargain hunters for as little as $50 a foot. The combination of these trends creates what experts call a barbell market. On one end, you have premium properties attracting institutional money. On the other, you have distressed assets being bought for pennies on the dollar. What really gets hollowed out in the middle are the mid-tier Class B buildings. These older properties have neither the appeal for top-tier tenants nor the bargain price for speculators. And that's a huge potential problem because regional banks are the ones that heavily finance this middle segment. A wave of defaults on these stranded assets could create a slow-burning credit crisis for those banks. A massive influx of capital, a sudden halt in new supply, and stabilizing demand are colliding. These green shoots are signals of a fundamental power shift set to reshape office valuations for years to come. So, as we watch this market reshape itself, there are a few key things to keep an eye on. First, watch that barbell. Will the recovery broaden to include those middle tier buildings, or will they continue to struggle and put pressure on the regional banks that hold their loans? The performance of these banks will be a critical indicator. Second, for our listeners in the Chinese-speaking world, it's important to note the source of this new capital. Unlike the 2015 to 2018 cycle, this wave is seeing less participation from Chinese investors and a notable increase from Middle Eastern and European funds, reflecting a broader geopolitical realignment of global capital. Finally, the ultimate test will be fundamental demand. The current boom is partly fueled by expectations of lower interest rates, but lower rates often signal a weaker economy, which could depress hiring. So keep a close watch on labour market data, especially in office-using sectors. That will be the true sign of whether this recovery is built on a solid foundation.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.